Good evening and welcome to today's property presentation section of the Capital Markets Showcase. I'm going to talk about property's place within a portfolio allocation, concentrating on the development stack because that's primarily what we do, using some real world examples that VentureCrowd has in the market currently. Property, of course, offers a broad spectrum of risk-adjusted returns, from passive income generation to more active investments in the equity and secured debt layers of property development projects. These opportunities, of course, have been generally gated, often requiring personal or other institutional relationships, often sourced through brokers, sometimes through pooled funds, often with large commissions and high minimum invested amounts. Property investment can offer solid portfolio diversification, and residential development returns are driven in large part by the performance of particular locations. And as you will see, we're very strong on the southeast Queensland property story. That particular market has seen some of the best capital growth probably anywhere in the world. Private direct property investment through VentureCrowd can and has generated returns in the range of 10 to 40%, depending on the project level of risk versus security. It's an attractive option for investors seeking higher growth returns as part of a mix. We've returned up to 40% for some of the equity tranches that we've given in some of our projects. Pref equity, we've generally targeted between about 12 and 18%. The lower ones on these generally represent timing in a lower interest rate environment. At the MES second mortgage stage, between 12 and 20%, and I'll talk a little bit more about one of those products coming up. And first mortgage stage, generally between about 9 and 12%. The property team that we have at VC is comprised of experienced development managers with about 100 years of experience between us. That doesn't mean we've got a heap of people. It means we've got a lot of experience with quite a small team, actually. So. We've got a number of live projects underway currently. We have different offer windows that do open and close depending on the project funding requirements. The second mortgage we have at Cumulus Carrara, which is open now. I'll concentrate on soon. I'll talk about that. A particularly interesting one we've got at the moment is equity in Morningside, top right, and also Morgal Ferry Road. Morningside co-living is a particularly interesting opportunity. It offers exposure to development and the ability for ownership as well. Its returns when it's operating will be about 6.75% net, growing to almost 8% by year 5, and that is net on a residential opportunity. Please do find me after the showcase if this one interests you, because that's something that requires a bit more conversation. Some of the closed opportunities examples include equity and pref at our 46 townhouse development in Albany Creek. Offers are closed and we're repatriating about $11 million of principal and interest, actually beginning effectively tomorrow, next month. And we've got equity and debt products on Glenvale, which is our 324 lot residential development in Toowoomba. It's about 50% sold. It's closed for investment currently because the first mortgage and the equity already invested will take us to the end of that project. Equity and P&I is progressively paid down at each stage settlement. You'll see from these projects that our investment thesis has been laser focused on the southeast Queensland, and particularly the project I'm going to talk about now, which is Cumulus at Carrara. It's on the Gold Coast, and Michael Matusik, who's one of the foremost property economists identified 7 core criteria underpinning an upcycle. The Gold Coast had every single one of those, namely population growth, employment growth, rising wages, undervalued housing, a supply shortage, a balanced demographic mix and lifestyle appeal. Many of you will have seen that Gold Coast average apartment values recently overtook Sydney. Coupled as well particularly is the dire undersupply of land in the Gold Coast region. Resale house listings are sitting at only 4 months supply, apartments and townhouses even worse at 3.6 months. So the project I'm going to focus on now is Cumulus at Carrara, where we're open for investment in a second mortgage product, offering 20% per annum with redemption of the facility targeted to commence the third quarter of next year. Cumulus comprises 59 luxury houses in a gated community on a ridge overlooking the broad beach skyline. The beach, Pack Fair shopping centre and numerous golf courses are only about 10 minutes away. Cumulus includes a common rec facility with tables, barbecues and a 20-metre long infinity pool. The entirety of our site is over 27 hectares, of which only 3 hectares is developed. The remainder contains walking tracks in that native vegetation, allowing residents to exercise and walk the dog. Civils are complete. Our experienced builder DevCon is on site piling and slabbing with framing imminent, and completion of that first stage of 23 plus the rec centre, as I said, is scheduled for the third quarter of next year. And that's when redemptions of that second mortgage are targeted to commence. We're offering a mix of luxury 3 and 4 bed houses, with some of the 4s having 2 master bedrooms, 1 up, 1 down, allowing for separated disability or intergenerational living. Most importantly, the prices range between about 1.5 million for the 3 beds to just over 2 million for the 4s. That's about 7,200 per square metre, or about half of a new non-beachfront apartment on the Gold Coast. So in other words, for the same price as an off-the-plan non-beachfront apartment, you'll get about double the house area, you'll get an extra car, you'll get all that bushland. On the funding side, the equity for this project was closed oversubscribed some time ago in just a few weeks. And our first mortgage is in place with a group called JVL, the Van Lieshout Group, some of you may know. And it's in place until the end of the project. We're not required to make pre-sales as a condition of the funding. Nevertheless, to ensure we commence payout of the second mortgage facility on settlements of the first stage next year, we've commenced sales with contracts, with a number of contracts in place already. We only need a very modest sales rate of under 2 sales a month to sell this stage out. In the project, it's, as is always the case, VentureCrowd's profits at risk first, then unit holders further up the risk curve in equity before the second mortgage. Gross profit on current revenues post-debt is forecasted just over $15 million. Pretty well all major costs, including the build contract especially, are all now locked in, and we will keenly look to drive revenue increases during construction, like we always do. At Glenvale, the large project you saw top left at Toowoomba, we were able to push those prices about 30% in 18 months. And at Albany Creek, the townhouse development on the bottom left, we raised prices by over 16% or 150,000 for a 3-bed townhouse in about a year. If we were able to do that across the project at Cumulus, that'd be another $8 million in revenue. As stated, the equity and first are placed. The second mortgage fund is the final opportunity for investors to have exposure to the project. After repayment of the facility, the first mortgage and equity are forecast to cover project costs for future stages. As I said, the fund offering 20% per annum is open for investment. If you'd like more information on the project or the fund, you can use the QR code that you can see on the banners back there or here to register your interest. One of our team will be in touch, or you can, of course, register privately through the VentureCrowd website inquiry. So thank you. That is a little case study on how we do property in the private markets.